With the SPY ETF hovering right near all-time highs today, April 15, 2026, I mean, are you seeing a definitive strong buy, or are those flashing overbought signals actually a warning of an incoming cliff?
Oh, it's a massive game of chicken right now.
Right, because right now, nearly $750 billion is basically playing chicken with market gravity.
Yeah, the tension in the data we're looking at today is just palpable. You have this immovable object, which is, relentless price agnostic institutional buying,
Hmm.
and that's colliding head on with an RSI that is absolutely screaming extreme greed.
And that collision is exactly what we're unpacking in today's deep dive. We've got a really heavy stack of sources on the table for the SPDR S&P 500 ETF Trust.
Yeah, we're skipping the basic overviews today.
Exactly. We are bypassing the 101 stuff and going straight into the raw financial flow data, the technical momentum structures, the latest news, analyst ratings.
And including that massive Goldman Sachs 7,600 target, right?
Oh, for sure. We have to talk about that. Plus, the underlying macroeconomic risks. Our mission today is to decode whether this current pricing is justified by fundamental growth or, if this whole setup is just a sophisticated liquidity trap waiting to spring on you.
It's a very real possibility.
It is. But hey, before we get completely lost in the charts, make sure to like the video and subscribe to our YouTube channel. And you compulsory have to leave us a comment with your feedback.
Yeah, let us know what you think.
Seriously, we read them all. So, okay, let's unpack this. SPY is basically the financial markets thermostat, right?
That's a good way to put it.
If it's running this hot, literally everyone feels it. But is it actual heat or just a fever?
Well, to understand the mechanics of that potential shrap, we really have to isolate the financial fuel driving this specific moment.
The raw vitals.
Exactly. The raw vitals on SPY today show it trading at $694.46.
Which is it's incredibly high.
Right. It puts it within a hair of its absolute 52-week peak, which is $697.84. The low is all the way down at 508.46.
And the sheer mass behind that price point is what makes this so incredibly complex.
The scale is hard to even visualize.
It really is. I mean, we're looking at assets under management, or AUM, sitting somewhere between $695.8 billion and $705 billion.
Yeah, that is the gravitational pull of the entire market right there.
But, when you look under the hood at the valuation, when you dig into the quarterly and annual income statements and look at the underlying balance sheets and cash flows of the companies making up that massive tool.
Oh, fundamentals, yeah.
Right, the aggregate PE ratio is sitting at 27.20. The price to cash flow is 18.73. And the dividend yield is only hovering around 1.04 to 1.14%.
Which is roughly, 7.19 to 7.38 per share annually.
Exactly. So I just have to push back on the idea that this is a sustainable equilibrium. I mean, at a 27 PE, that feels like paying scalper prices for front row concert tickets.
That's a hefty premium.
Are the underlying companies really putting on a good enough show to justify all that kind of entry price? Because it feels like future growth might already be fully priced in.
I mean, the traditional value models would completely agree with you. A 27 PE is objectively just stretched for the broader index.
Right.
But fundamental valuation metrics are essentially useless if we ignore the mechanics of modern market structure.
What do you mean by that?
Well, the flow data we have highlights a massive ongoing surge in institutional inflows. And this is specifically driven by fee-sensitive, passive buyers.
Because of the 0.09% expense ratio.
Exactly. The institutions aren't buying the S&P 500 because they're just in love with the 27 PE.
They don't care about the multiple.
Right. They're buying it because it's the absolute most capital-efficient way to park billions of dollars of incoming 401k and pension money.
Okay, that makes sense. So you're saying the passive institutional demand is kind of warping the valuation?
Yeah, think of it like a massive cargo ship with a stuck throttle.
Oh, I like that.
When a mega fund gets its biweekly influx of global retirement capital, the trading algorithms don't, pause to debate whether a 27 multiple is too expensive compared to historical averages.
They don't check the balance sheet.
Not at all. They simply execute the mandate. They buy SPY. It is a completely price-agnostic bid.
Wow. So even if the captain of that cargo ship, like the traditional value investor, clearly sees the iceberg of overvaluation on the horizon.
A ship can't stop.
Right. The sheer momentum of passive inflows means the ship simply cannot stop turning for miles. The structural bid just overrides the fundamental warning.
Exactly. And that structural bid creates a relentless floor under the market, at least until some sort of macroeconomic shock forces a systemic reevaluation.
Which we'll definitely get into.
Yeah. But because that passive buying is so unbelievably consistent, it forces us to look at the momentum on the technical charts. We need to understand when this blind buying actually risks running out of steam.
Which brings us to the technical analysis, because the divergence we're seeing on the daily timeframes is looking historically violent.
It's stretched for sure.
Extremely stretched. I mean, we're trading at 694 right now.
Yeah.
But the 50-day simple moving average is all the way down at 674.18.
And the 200-day is even further.
Way further. The 200-day SMA is lagging massively down at 665.17. Aren't we stretched like a rubber band here?
Oh, completely. When an asset trades that far above its 200-day moving average, algorithmic risk models are literally forced to classify the trend as parabolic.
Meaning it has to snap back.
Right. The algorithms know the historical probability of a mean reversion event increases exponentially the wider that gap gets.
But it hasn't snapped back yet.
No, because the short-term triggers are forcing those exact same algorithms to stay long.
Ah, because of the MACD spread.
Yes, the MACD.
The data shows the daily MACD, the 12 and 26, is sitting between 3.17 and 6.03. So as long as that spread stays positive and doesn't cross over, the short-term trend-following algos are mathematically bound to keep riding the wave upward.
Even though there's a massive air pocket forming beneath them down to that 665 level.
They're just writing the math.
They are. But human traders looking at this chart, they see a very specific hard ceiling approaching.
The resistance.
Yeah, the immediate resistance level is documented at 696.76, which is basically sitting on the doorstep of that 52-week high of 697.84.
So when a parabolic trend meets a historical resistance ceiling,
the market enters a state of maximum fragility.
So it's like driving a sports car with the tachometer pinned in the red line. I mean, you are absolutely flying. The momentum feels incredible, but the engine is under so much stress that hitting a single pothole could tear the entire transmission apart.
That is a perfect analogy.
And the pothole in this scenario is that 697 resistance level.
And the rejection at that level could be extremely fierce. The sources outline immediate pivot support at 676.86.
Okay, so a decent drop.
But if that fails, there really isn't significant structural support until 640.16.
Oh, wow. So that represents a massive drawdown.
Huge. And the catalyst for that kind of rejection is usually a sudden shift in sentiment right at the top.
Which makes the consensus analyst ratings feel almost predatory right now, honestly.
How's it?
Well, you have the consensus screaming strong buy, heavily anchored by Goldman Sachs, throwing out this massive 7,600 target for the S&P 500 by year-end 2026.
That's a huge target.
Right. And a headline like that acts as a total magnet for retail capital. But if we cross-reference that Goldman target with the RSI data,
A relative strength index, yeah.
yeah, a very dark picture starts to emerge about who is actually buying at these levels.
Yeah.
Because we have to debate whether this is truly undervalued potential or just a classic value trap.
The RSI data is absolutely the smoking gun here. The daily RSI for SPY is currently sitting in a band between 72.46 and 80.37.
We are pushing 80.
Yeah, it's wild.
So we aren't just overbought, we are deep into extreme greed territory.
Exactly.
The buying pressure has been so relentless that the asset is hyper-vulnerable to a liquidity vacuum. So it's essentially a game of musical chairs, right?
Yeah, 100%.
Everyone is happily dancing to Goldman's 7,600 target tune, but with an RSI hitting 80, the music's about to pause. Why do retail investors always seem to be the ones left without a seat?
Well, when you combine an RSI of 80 with a price-testing major resistance, you are basically looking at the classic anatomy of a sentiment-fueled value trap.
A retail trap.
Yeah, because the institutions putting out those massive 7,600 price targets, they know exactly how algorithmic news scrapers and retail traders react to those headlines.
FOMO. Fear of missing out.
Exactly. It generates a wave of late-stage buying. The retail traders see the Goldman headline, they see the green arrows on their brokerage apps, and they market buy right at that 697 resistance ceiling.
Oh, that is brutal. Meanwhile, the smart money is using that massive influx of retail buy orders as the necessary liquidity to quietly offload their own positions.
They're setting up hedges.
Yeah, the retail trader is unknowingly acting as the exit liquidity for the institutions.
You're describing the exact mechanism of distribution. I mean, institutions cannot easily sell billions of dollars of SPY without tanking the price against them.
Right, there's too much volume.
So they require a total frenzy of buying to absorb their selling. An RSI of 80 combined with a major analyst upgrade provides the absolute perfect cover for that distribution.
Wow. That makes the downside risks outlined in our sources feels so much more immediate.
It really does.
Because we aren't just talking about lines on a chart crossing over anymore. We're talking about a highly leveraged, overextended market that is incredibly sensitive to an external shock.
The DJ that suddenly cuts the music, going back to your analogy.
Exactly. And the sources specifically highlight ongoing geopolitical tensions, primarily in the Middle East, as the prime catalyst for this.
A geopolitical shock exposes the underlying fragility of that 27 PE ratio we talked about earlier.
How does that play out?
Well, if an escalation in the Middle East suddenly spikes global oil prices, the immediate systemic reaction alters the whole inflation narrative.
Because energy costs ripple through everything.
Right. And if inflation projections tick up, the market instantly assumes the Federal Reserve will have to maintain tighter liquidity to keep rates higher.
And tighter liquidity instantly re-rates the valuation multiple.
Yeah.
You just can't justify a 27 PE if the cost of capital suddenly spikes.
No, you can't. And that repricing, it happens in milliseconds. Risk parity funds, which automatically balance their exposure based on volatility metrics, they would immediately degross their portfolios.
Well, automatic.
Entirely. The algorithms don't wait for a human portfolio manager to analyze the geopolitical news. The spike in the VIX triggers a mechanical automatic sell-off.
That's the sudden defensive shift from equities over to fixed income.
Precisely.
And because literally everyone is crowding the exact same side of the trade right now, running for the exit at the exact same time means that 676 support level is going to get vaporized.
Oh, easily.
Sending the price tumbling into that air pocket down toward the 640 structural floor.
And that cascade of algorithmic selling, that is the core of the bear case scenario presented in the data.
A sharp continuation lower.
Right. The overbought technicals, the stretched valuations, and the extreme greed sentiment, they finally buckle under the weight of an unpredictable macro shock, causing a violent rejection at the 52-week high.
But, if we are being completely objective with the source material here, we have to acknowledge that the bear case is fighting against a massively powerful long-term fundamental narrative.
That's the bull case.
Yeah, the bull case isn't just relying on blind passive flows. There is actual tangible economic data supporting a breakout above that 697 ceiling.
And the most compelling piece of data supporting that bull case is the projected underlying earnings growth.
Yeah, let's talk about that.
The sources highlight an expected aggregate earnings growth rate of 14.5% over the next 3 to 5 years for the S&P 500 companies.
See, that 14.5% number changes the entire math equation.
It really does.
This is the denominator effect in action. If the earnings, which is the denominator in the PE ratio, grow by 14.5%, then even if the SPY price stays exactly where it is today, the PE ratio naturally compresses over time.
It organically becomes cheaper.
Exactly. The earnings growth essentially bails out the current overvaluation.
Right. If those Q1 2026 earnings reports come in hot, the market doesn't view the 27 PE as an expensive premium anymore. It views it as a completely rational forward pricing of incoming capital.
And the sources show that this earnings growth is no longer just isolated to a handful of mega-cap tech giants.
The participation is widening.
Right. The internal mechanics of the SPY are shifting. We are seeing a real broadening out of market participation. Cyclical stocks, industrials, mid-tier companies, they're finally joining the rally.
And sector rotation is the hallmark of a maturing, healthy bull market.
It's not just a tech bubble anymore.
Exactly. When the heavy lifting is distributed across multiple sectors, the index becomes much more resilient to localized shocks.
Makes sense.
If technology stocks stall out for a quarter to consolidate, but industrials and financials surge because of robust economic data, well, the SPY ETF just holds its elevated levels.
Which brings us to a really fascinating realization about the conflict in our sources. Here's where it gets really interesting.
Okay, lay it on me.
Earlier, we established that smart money might be using retail FOMO as exit liquidity, right?
Right, the value trap.
But what if we flip that thesis? If institutions are actively aggressively buying right now, and I mean actively allocating capital, not just passively through 401k flows, despite an RSI of 80 and a 27 multiple.
They must be front-running something massive.
Right. So what does this all mean? Is the short-term danger just a speed bump on a long-term highway?
They are pricing in a reality that the lagging technical indicators just haven't registered yet.
Because charts look backwards.
Exactly. Technical analysis looks backward at what price is already done, but institutional algorithms are entirely forward-looking.
Right.
If proprietary institutional data suggests that the upcoming Q1 earnings are going to massively beat consensus estimates across multiple sectors, then buying SPY at 694 isn't a trap, it's an early entry.
Wow. So we are looking at two entirely different yet completely valid narratives playing out simultaneously. And they are entirely dependent on your time horizon.
Time horizon is everything here.
Because the short-term mechanics of the market, the short-term outlook, is flashing deep red.
Oh, absolutely.
The technicals and the sentiment indicators are screaming that the next few weeks are going to be a volatile minefield as we battle at that 697 resistance.
Trading the short-term noise right now requires navigating extreme statistical danger.
It's risky.
Very. The probability of a violent whipsaw or a sharp pullback just to reset the RSI is incredibly high.
But the long-term fundamental engine is telling a completely different story. A story of 14.5% structural growth and broadening economic participation.
The medium to long-term outlook remains distinctly bullish.
So for an investor looking at a 5-year horizon, today's price action might just be minor turbulence on a much longer flight path.
And mixing up those two time horizons is the absolute easiest way to destroy capital.
How so?
Well, if you buy today because you believe in the 5-year 14.5% growth story, but then you panic and sell next week because a geopolitical shock drops the price to 640.
You've traded a long-term thesis with short-term emotions.
Exactly. You have to know exactly what game you're playing before you put chips on the table.
That is incredibly well said.
Yeah.
To synthesize all the data we've torn through today, just to wrap this up, SPY is currently sitting on a razor's edge at 694.46.
Right at the top.
It is supported by an absolute ocean of massive institutional momentum and incredibly strong long-term earnings forecasts.
But the immediate reality is a market exhibiting extreme greed.
The RSI.
Right. Stretched multiples, parabolic separation from its moving averages, all while staring down a massive historical resistance ceiling.
It is the ultimate staring contest between algorithmic momentum and fundamental gravity.
It really is.
And as always, as a reminder, because we are analyzing live market dynamics and high-stakes data, remember we're here to debate the data and share insights from our sources. We are not giving financial advice.
No, definitely not.
How you choose to navigate the friction between the short-term technical warnings and long-term growth projections, that's entirely up to you.
The data provides the map, but you have to decide which road you're actually driving.
Which leaves us with one final, incredibly provocative question to consider.
Let's hear it.
We know the technical charts are completely blind to the future, but if the smart money institutions are willing to aggressively buy this market right now at an 80 RSI, knowing full well the historical risks of a pullback.
What exactly do they see?
Right, what exact data points did they see in those upcoming Q1 earnings that the technical charts simply can't show us, giving them the confidence to completely ignore market gravity today?